afternoon and welcome to Market Wrap number 133. Stuart Williamson as ever here at the helm, trying to supply information, a bit more knowledge to our clients, to expatriates, to international investors, bite-sized bits, just so you can get a grip in your time stressed lives to find out what's going on and how to work out what the future might hold. This episode we're going to look at the influences of 2023. What are the 5 economic indicators for the housing markets in the UK? So firstly, what a 12 months it's been. It's been amazing. Ups and downs, an emotional roller coaster. Let's have a look at the future though. Inevitably, in such turbulent times, it's hard to predict the future with any certainty, but the following 5 key metrics will be the ones that matter for global housing markets in 2023, we believe at APW Towers, plus our research. Economic growth is going to be tempered. Some economies, especially across Europe, have almost certainly already entered a recession, and others, such as the US, may soon follow. The chart below shows this. Average forecast values for 2022, 2023 and 4 across the world, Euro area and G7 nations. Next year we will see growth slow, but the year after that the downturn will be mild by historical standards and therefore an opportunity for economies to reset. The cost of debt and inflation are weighing on sentiment and spending, the path of which we will discuss now. Inflation peaked in 2022. The path of inflation will determine the course of interest rates and the results will reverberate through the global asset prices. Central bankers, particularly the Fed's Reserve, Jerome Powell, were humbled by their errors in assuming inflation would be transitory. And as a result, they have doubled down on their commitment to tame inflation. We've seen that with the Bank of England. But in the clearest message yet, the resolve seems to be working and peak inflation is in the rear-view mirror. The US headline rate has been falling steadily since June, with a November reading of 7.1%, a full 2 percentage points below the peak. Wage demands may start to alleviate, with vacancies starting to fall back, while global supply chains are easing and oil prices have fallen below the high $70 or low 80s at the time of writing, way down from the $120 a barrel early this year. It's also worth noting that the transitory inflation was largely about durable goods, ones which have a long period between purchase, i.e. cars, appliances, furniture, etc. And for this category, the measure peaked at 18.7% in February, but is already down to 2.4% by November, and one of the most dramatic disinflations on record. Inflation may have peaked later in Europe and the UK due to the acute impact of the energy prices, but the global signs of respite are definitely out there. Number 3, interest rates top out in early 2023. Due to the return of the double-digit inflation, this year has marked a swift and seismic change in the monetary environment as policymakers grappled with higher levels. The US Federal Reserve raised its target rate by 4.25 basis points in 2022. Putting this in historical context, any calendar year, the Fed has only twice hiked rates, more than it did in 2022. 5.38 in 1973 and 4.5 in 1980. The Bank of England and ECB have also moved to 325 basis points to 3.5 and up to 2.5 in the euro. Even the Bank of Japan surprised markets this month with a policy tweak that would allow rates to fluctuate 50 basis points from its 0% target instead of 25 basis points. So we're now entering a new phase of rate setting where hikes will become smaller in magnitude. Australia and Canada started this in October and others joined ranks in December. There is a broad expectation that rates will peak in the first half of 2023. Consensus among forecasters and markets is that they will reach 5% in the US, 4.5% in the UK and 3% across the euro area. Unsurprisingly, all this has brought the affordability of residential property to the fore and prices are being tested by the regime changes. By way of example, the average mortgage payment between January and November rose 59% in the UK and 48% in the US, just based on interest rate changes alone. That doesn't include the fear factor from banks. With many predicting that economic slowdowns will encourage central banks to rate cuts from Q4 2023, this could offer some respite for the sector. The timing and magnitude of the peak for this rate hiking cycle remains at the mercy of inflation and is a key risk for housing markets and investors. Number 4, unemployment is likely to rise, but only marginally. One positive that many economies are starting this new cycle with a relatively strong employment market. Across the G7 economies, the average unemployment rate was 5% using latest statistics, down from almost 6% a year ago. Although the headline rate is likely to tick up in many economies as growth slows, or indeed they endure a recession, albeit a soggy recession, there is not expected to be a dramatic rise in the number of jobless. The consensus is that the rate will rise from an average of 5% in 2022 to 5.6% in 2023 and 5.7% in 2024. This, combined with an average somewhat more savings in bank accounts, that was done during a pandemic, indicates that economic downturn could be shorter and shallower than previous cycles, a positive for residential markets. Number 5, currency. The US dollar is going to lose some ground. The US dollar has started to see some of its strength it gathered during 2022 wane. At its peak in early November, the dollar's yearly gains were more than 10% against a basket of currencies. This came off the back of the Federal Reserve's earlier rate hiking, as well as the currency safe haven status. Only 2 currencies have strengthened against the greenback in 2022, the Brazilian real and the Russian ruble. However, as policy starts to shift, the dollar will begin to fall back, and this slide is likely to continue into 2023. With November's better than anticipated inflation readings, the dollar lost 1%. The yen bounced on the back of the Bank of Japan's shock move to tweak its rate-setting policy. It had previously been down by more than 20% against the dollar. The pound, by way of example, has bounced back from the lows of 104 after the quasi-quatrain Liz Truss experience in September to 122 at the time of putting this together. Still below the 135 at the outset of 2022, but there is plenty of upside there. Whilst dollar-denominated and linked currency denominated buyers have had a purchasing power advantage in 2022, this could be seen start to reverse in 2023. So what we have really is a soggy recession, because you don't have the indicators which would normally indicate a hard recession, which is high unemployment and high inflation created by consumers or governments. We actually have none of that. It's been created by, as we know, energy prices, external, and the Ukraine situation. So the outlook for the UK market, it is for 2023 checkered. It's really a case of looking at where you're buying and what you're buying for, looking at ties, transport, infrastructure, employment, those sort of things, and making sure you're buying for the right reasons. So that's it for 2022. That's our indicator for 2023. Thank you for watching. Do subscribe. Do like if you can. Go to our podcast and look at those. Don't fill in the form at the bottom if you wish to have a bit more information from us. And do take care. Wishing you all the best for 2023. Thank you.